Alright guys, welcome to Week Ahead. It's to 12 June 2020. So how was your trading and investment week, prayer week? Hope you had a great one and hope you heeded to the advice we dropped here. Okay, like we normally do, we look at remember we cover the macro, equity markets, bond, and then currency. So anyone you play, you can use the timestamp to jump to your area of interest. So we'll compete firm that oversees this market. Then for the currency guys, like always at the end of the day, we show you some directional bias for some currency pairs. Of course, we focus on the eight major currency pairs. So first thing first, like we normally do, we look at the prior week, what happened macro-wise. After that, we talk about the bond markets. Then we go to the macros of this week. Then we look at the equity markets, which is Nigeria and the US markets. Then we just see if there's any geopolitical tension looming out there. Then after that, we go to the chart and show you some technical currency trade bias, something of that nature. So first thing first, in the US prayer week, the last more jobs was added, over 1,700 plus K job was added. So pretty well labor markets, So the labor market looks robust for now, even though you can question the quality of the job, but it looks robust. Even the market Fed pricing range that you help the Fed stay hawkish, because now what could have derailed them from the hawkish rhetoric the market is pricing is, had even the labor market dropped, it would be like they need to prop up the labor market. But since the labor market is showing resilience, that is just how this market works sometimes. That is why you see the president come out and say, no, that growth does not mean inflection. That growth does not mean, because the playbook is, once the labor market is threatening, it means there is going to be spending there, and if there is going to be spending, it's going to lead to inflection. So that is just one narrative they are trying to say. The same thing in Canada. Canada also, their job market is threatening quite significantly. Then for the Eurozone, the economy contracted minus 0.2% for the Q1 2026, and the inflation is heading up. So the very line edge is this now. The Eurozone is not in a good place at all. But the market is still pricing, and we are still going to talk about their rate decision. But they are not really in a good place growth-wise, and inflation is hitting. So it's really between the bedrock and the deep sea. Then for the Switzerland, in Switzerland, the job market's load, if you overlay it with the seasonally adjusted matrix, not the non-seasonal one. If you look at the non-seasonal one, you say that the job market is still pretty great. But if you adjust its 3 period, because the Switzerland economy somehow reacts to seasonality, the level side of the economy. So if you strip it out, all this construction, all those stuff like that, you see that the labor market weakened a little bit. Then finally in Australia too, the gross load Q1 2026. So that's it. Then for the job then markets. So if you look at this is the VIX first. You see that if you look at the VIX, we're still going to talk about it. Then for the bond market, you see that yields are still elevated. In the US, yield is still, 10-year yield is still over 4.5 plus-ish %, stuff like that. UK, even though it has retracted a little bit, but outside their yields are elevated because of the bond market is expecting that the inflation shock, always shock will lead to inflation, and the central bankers are going to hike. So that's it. So the bank vigilantes, they are still very much aware. So this elevated yield is not good for anybody. For the macro of this week, so this week is a light data packed week, so it's just a light data here and there. In the US, we are expecting the inflection print. Currently, inflection headline CPI inflection in US is currently at 3.8%. So we'll be watching that. Remember, the labor market strengthened within the week. If inflation keep on ticking up, then there will trick up that the Fed is going to hike. The market will keep dialing it in. But if you look at the president's body language, you see that he's already saying, I expect Walsh to do his thing and other things. But kind of, so all eye on that job data, like that inflection data. If you look at some of the forecasts out there, you see that the forecast is that the labor market is going to tick over 4% plus. But let's see though. Then in Canada, there is going to be a rate decision. The BOC, Bank of Canada, they're going to meet and make some rate decision. The consensus out there is already the Canadian economy, remember Q1, it's contracted and technically they are in a technical recession if you overlay it year on year. But due to the job market strengthening a little bit, so it gave life to it. It gave life to that economy, somehow signaling some green light at the end of the tunnel, stuff like that. But now the BOC, the very language is this, is that they are not going to really hike, but they might sound hawkish hold, because if you want to hike, it's not good to hike into slowdown. So unless you want to sacrifice one part of your mandate, remember central bankers, they have mandate, growth and inflation, price stability and the growth. So unless you want to sacrifice one, but generally the consensus out there is that they are going to hold rates. So let's see how it plays out. Then the next central banker that is going to meet is the ECB. Finally, the market is pricing that despite this slowdown in the Eurozone, that the ECB is going to hike because inflation is heading up. So they call it insurance hike. Just the kind of hike, guys, we are here, let's just hike a little bit. So the market is pricing that ECB is going to hike by 25 basis points. So that is just it. They call it a kind of one and done form of hike. But if you look at growth rise, they don't have the they have enough lever to pull up that hike, but they can just do it. Central banks do it. Then the last thing of the weather is in Japan. You are going to see the final print of the GDP data. Already growth came back to Japan. Their labor side of Japanese economy also strengthened. The CRK point said the job to vacancy ratio was pretty okay. Like they have more job than the vacancy. So I bet you that that final print is going to look at. If it looks positive, currently the previous print was at 0.5. If it looks positive, it might start supporting the rhetoric that the BOJ will hike sometime this June. Then so that is it about the macro, no more stuff. Then for the equity part of stuff, so you have to look at, if you look at the US, the looming stuff is the AI love affair continues. The data centers are being built. You see what these guys are doing, Google, right? You see what they are doing. That's Google Alphabet. You see what they are doing, trying to sell more shares. What's it called? Meta too, trying to see if they will told that part. Berkshire Hathaway, that's Warren's company, Warren Buffett's company, also even bought kind of into that too. So it means the AI spending capacity is still out there. Then amidst that, the IPOs are lining up. Mops IPO, Anthropic IPO, this is lining up. So it's interesting to see how these things pan out. Then for the Nigerian equity side of things, the market is still very much year to date over 50, 60 something percent, right? Then the new thing that came on the block, remember there is credit rating agency, S&P, that's Standard & Poor's. They rated most of, starting with the sovereign bonds, be stable now, unlike the previous rating that was B negative and stuff like that, they rated the corporate bonds too. Now the next thing is that in Nigeria has transited to T+1. That means if you buy your stock today, you're gonna get your money to. If you sell today, you get your money tomorrow. So they have transitioned. The first exchange to do is in Africa. So it's quite commendable. Let's see how that pans out. Outside, also the extension of the trading hours. So really, really good stuff going out there. Then finally, on the geopolitical front, before we look at the chart, is the US and Iran rhetoric is still out there. That it's just a stalemate. We are in ceasefire, guys. But we are doing some protective strike, kind of to protect ourselves. Just look at that headline. That looks like the oil market has capped a little bit, but nobody knows. Let's see how it all pans out. So go to the chart. If you look at the VIX, so VIX has ticked up back again due to some strike here and there and moon squares and stuff like that. So VIX has ticked up. So if you know the VIX playbook is that whenever VIX is above 20%, it means risk are out there. Below 20 risks. So we are back from the VIX point, which tracks stocks though. Which tracks stocks. So from the VIX point of view, so it's the volatility for S&P 500. So from the VIX side, we are in a risk off mode, and you see stocks sold off on Friday. So from the currency front, let's look at some of the things we have on the radar. So now we are bullish on the New Zealand dollar. Then we say bullish, you have to know that currency is like 1.15, so you need to pair the one that look economically great and all the metrics against the weak one. So when you're bullish on New Zealand dollar, or that we said we bullish, doesn't mean that we are going to sell everything or buy everything out there with New Zealand. What we just need to do is to pair it with a weaker currency until the data changes, because it's the data that determines the narrative. The weaker side, we don't depict it from a technical point. That's why we are a research firm. We do that from a macro standpoint. All those macro data, we overlay it into our model and come to a conclusion. So now, the next thing is to go to the chart and look for technical levels. Because it's only from the technical level you know when the buyers have stepped in. Certainly from a higher time frame perspective. So we will be looking out throughout the week to sell the New Zealand, to sell the euro using the New Zealand. So euro NZD will be looking for a sell. Remember the meeting is coming up, the ECB meeting. So all those things you factor in. So we'll be waiting. Sometimes there are risks. You can wait for that idea. You are waiting for your technical level to hit. It doesn't hit. You wait. That means the buyers are not ready, but it doesn't change your bias. So very will be looking to do the same thing with NZD chart. Remember, we were selling this if you watch our previous videos 2-3 weeks ago. But now the narrative have flipped to a buy. So we'll be looking to buy the NZD chart all through the week. Now for the yen too, we'll be looking to the two currency we want to sell. The yen that we want to sell, we want to use the yen to short is the pound and the Australian dollar. Then for the euro dollar, we are still very much bearish, just looking for the technical levels to print out there. Then euro chart to the same thing, we are bullish on it. Then for the card chart, yeah, we are not bullish on the card a little bit. So we'll be looking to buy the card Swiss and sell the euro card. So that is the currency play we have for the week. So remember to subscribe to the channel, follow us. Then from the equity side of things, investment and stuff like that, yeah, NGS, all those things, you will follow us on X. You watch all our free analysis. We are breaking down the fundamentals of those companies, their results. Q1, we have analyzed custodian, Stanbic, just all the videos I did, Q1 2021. Some of those companies, you see how they are faring. Then if you are confused about it, watch some of our videos, reach out to the team, we guide you on how to invest in Nigerian market and the US stock market, while you trade other things like your currency or whatever you want to do. But remember, you have to stay invested. So you earn those dividends and stuff like that and build wealth for yourself. So till then, have a splendid week. Peace out.